Good evening. I'm Bob Glauber. I am a member of the faculty of the Center for Business and Government. And of course, I have the pleasure this evening to introduce Gary Gensler, who is the chairman of the Commodity Futures Trading Commission, as this year's speaker in what is called the Glauber Lecture. This is an annual event thanks to the generous financial commitment from what is now FINRA, the Financial Institutions Regulatory Authority, which was at one time called NASD, as the private sector regulator of the securities industry. I was fortunate enough to work for NASD for a handful of years in the 2000s. Gary has been chairman of the CFTC since May 2009. Once one of the perhaps lesser-known financial regulators, the CFTC has been brought to the forefront of public attention by the financial crisis, by the DoddFrank Act that Congress passed to deal with the financial crisis, and very frankly, by the vigorous activities of Gary. The CFTC is a relatively young financial regulator, having been created in 1974 to oversee trading in futures contracts. These contracts were traditionally, I think, of more interest to farmers than to financiers, having value based on future delivery of such agricultural commodities as wheat, corn, butter. But these, crucially, are contracts that are derivative contracts, that is, with their value deriving from the value of an underlying asset. And in the 1970s and 1980s, these derivative contracts were expanded to include financial underlying assets, such as interest rates and stock indices. And with those innovations, the importance of the CFTC really took off. It was deeply involved in understanding the stock market crash of October 1987, which was triggered by the interaction of stocks and stock index futures. But what really thrust the regulator into the limelight was the role in the 2008 financial crisis of such newly minted financial derivatives as credit default swaps. Recognizing the importance of these contracts to financial stability and the relatively low level of federal regulation over them, the DoddFrank Act empowered the CFTC with broad authority over the regulation of derivatives contracts. Agency has been very busy over the last 3 years writing rules to implement this Dodd-Frank legislation. Many of these rules are written to carry out Congress's direction that derivatives are to be traded when possible on organized exchanges and cleared through central clearing houses. The regulatory initiatives to accomplish this have stirred a great deal of controversy. Gary, like it seems many appointees of the recent administration, had his business career at Goldman Sachs, where he became a partner and before his retirement was co-head of finance. Prior to the CFTC, his government service was at the Treasury Department in the 1990s and the very early 2000s, first as Assistant Secretary for Domestic Finance and then as Undersecretary for Domestic Finance. In a small world department, I served in the post of Undersecretary a few years before Gary did. Subsequent to his Treasury service, he was a senior advisor to Senator Paul Sarbanes in writing the Sarbanes-Oxley Act, which of course played a very important role in reforming accounting regulation. Gary's academic background was at the University of Pennsylvania, first with a BS in economics and then with an MBA from the Wharton School. We are certainly most fortunate to have Gary as this year's speaker. He has been at the center of some of the most important and controversial rulemaking growing out of the financial crisis. I hope in his remarks he will at least touch on the regulatory efforts to put derivatives on exchange and in clearinghouses, what's been accomplished, what hasn't been, and why it's proven so difficult. But whatever he speaks about, we are certainly in for a very, very interesting talk. Thank you very much for coming.
I want to thank you, Bob, for that kind introduction, and I'd like to thank Harvard University for inviting me here to speak. I certainly could never have gotten invited to Harvard for anything when I was 17 years old, or 22, or 32. But Bob, you're kind, and you're proof that there is life after being an Undersecretary of the Treasury. So I hope that's true for me. 5 years ago, the U.S. economy was in free fall. 5 years ago, something called the swaps market was at the center of that crisis. It cost middle-class Americans and hardworking people around the globe their jobs, their pensions, their homes. 5 years ago, the swaps market contributed to a financial system failing corporate America and the economy at large, and thousands of businesses as well closed their doors. President Obama met in 2009 in Pittsburgh with the G20 leaders, and they committed together internationally to bring the swaps market into the light through transparency and oversight. And the President and Congress in 2010 gave the task of implementing much of this reform to an agency that you probably would never have heard of, I'm guessing, unless you grew up on a farm somewhere, which is the Commodity Futures Trading Commission, and did give jurisdiction for another product called securities-based swaps over to the SEC. Now, Bob talked a little bit about the 1987 stock market crash. I remember being at Goldman Sachs in those days when the stock market dropped about 500 points, was it, if I remember? And that was not 508 points on a market at 16,000. It was 508 on a market at, was it 1,800?
Yeah, it was 22.5%.
Yeah, 22.5%. So it was quite a change. And then Nick Brady brought him to the U.S. Treasury. Bob Rubin later brought me, and we hail from different parties, but we're both in that great tradition. See, the Commodity Futures Trading Commission was formed actually a little earlier than Bob said, but in the 1930s when President Roosevelt went to Congress and asked for two things in one speech. He said he needed a law and an agency to ensure against manipulation and speculation in the securities markets. You know something about the SEC, and that great reform is usually taught in history books. But what often they leave out of the history books is something called the Commodity Exchange Act in 1936, and our little predecessor, the Commodity Exchange Authority, was a part of the Department of Agriculture, and it oversaw grain futures for corn and wheat and soy and onions until the 1950s when a congressman from Michigan got rid of that. His name was Gerald Ford, by the way. It's against the law in America to trade futures on onions. But Gerald Ford did not say it was going to be against the law to trade swaps on credit derivatives or something. Any event, fast forward in the 1980s, just about the time that Eddie Murphy and Dan Aykroyd were making that great movie, Trading Places. Do any of the students, you're too young, do you know the movie? If you want to know anything about the Commodity Futures Trading Commission, go see the movie Trading Places, where there's this little caper and scheme about trading concentrated, frozen orange juice futures, which still exist, by the way. I'm the dude that has to regulate that too. In any event, at that same point in time, something else was invented, swaps. It was Solomon Brothers in 1981 did their first trade between the World Bank and IBM, and they were trying to exchange payments between those institutions, and a swap was created. And it went unregulated for the next nearly 30 years. But it was at the part of the crisis. And the President and Congress came together and passed reform. We now are near completion with the reforms over this marketplace, and I'm going to give you a little update. We've now finalized over 60 rules. See, when Congress passes a law, are there any law students in this spectrum? So do you learn, are you a Harvard law student? Oh my gosh, it's very fancy. But you might learn somewhere in civics class, as I did, or in the law school, that when the president signs a law, it's the law of the land, maybe. It's not true. It's just not true. And Doug Shulman will probably tell you, because he ran the IRS, that even sometimes it's only when the IRS does a rule, or the CFTC or SEC does a rule, that it might be almost in time a law of the land. Because even then, you have to have staff to go out and enforce the law and ensure for compliance. So Congress passed the DoddFrank Act, and they gave federal regulators 400 places to write rules. This is part of our political system where Congress is dealing with highly technical things, but they also can't agree with each other amongst themselves, and so they kick the ball down the field, in essence, and give deference to federal regulators. And over 60 places, the CFTC was asked to write rules, and we have completed that task. We were given 1 year to do it, but those students know sometimes if a professor gives you 1 week to do something, it would be better to take a little bit more time and get it right. Isn't that what you tell this? No, you don't tell the professors that. Well, in any event, we took 3 years to get it right rather than trying to do it all in 1 year. And what do these reforms do? They bring bright light and, I think, safety to the market that didn't exist in 2008. These reforms, whether it's for farmers and ranchers or producers that had to worry about corn futures and wheat futures in the beginning, or whether it's for commercial firms trying to hedge their risk in the interest rate markets, now bring a transparent, competitive marketplace forward for them. And anyone who studies economics knows that transparency and competition means something. In fact, you can go back to the founding of economics and read The Wealth of Nations by Adam Smith, and he talks about the benefits of lowering price, lowering the price of information, or lowering the price of access to a market. And if you can really make information free or make access free, then that inspires great competition in a marketplace. And we didn't have that in this marketplace. And that's, in essence, the core of the reforms. First, in line with what Adam Smith might suggest, today the public can actually see the price and volume of these transactions. There are real, live ticker tapes that you can, for free, see the price and volume of transactions that you couldn't see 5 years ago. This went live December 31st. We had phasing all the way through September 30th. Whether it's a customized transaction or a very standard transaction, thanks to Senator Jack Reed, it's the whole entire market. You can see the pricing. Professors can try to make sense of it. Businesses can try to make sense of it. This transparency, I think, lowers costs to investors and consumers. And regulators also can see a great deal more. There is currently over $400 trillion notional of derivatives in data warehouses. There's 3 main data warehouses, but we literally have $400 trillion of transactions. Let me size that a little bit. That's $23 of derivatives for every dollar of goods and services in our economy. $23 of derivatives. And this, by the way, for those geeky amongst you, like I am, this is single count. So if I entered a trade with the professor here, we're only counting that once. We're not counting that twice. So I just wanted to make sure. This transparency spans the entire market, every product set. Further, starting this month, we have trading platforms that had to register with us. There's 17 registered trading platforms called swap execution facilities. What does that really mean? It means that now the platforms that trade these derivatives, and they're trading on the platforms about 2,000 transactions a day. It doesn't sound like the stock market, but each of these transactions are measured in the tens of millions of dollars of size. And that 2,000 transactions a day is about a third of the market trading today, is now on platforms, to give you a sense of some of the dynamics. These trading platforms require that all market participants, dealers and non-dealers, get to see the prices before the transactions, that there's some order book where you can see bids and offers and transparency. So back to Adam Smith, transparency is real. We've accomplished it after the transaction with a real-time ticker tape. We've accomplished it in part before the transaction with the regulated platforms, and then the regulators have the information as well. Requiring these platforms to be registered and overseen was one of the key things President Obama, in fact, candidate Obama, laid out in June of 2008 when he said we had to close something then called the Enron loophole. But in essence, what he was saying is you had to have some oversight to markets, that markets work better, just as President Roosevelt knew in the 1930s. Another key component we completed was called central clearing. This was not a modern day thing. In the 1890s, way before Dan Aykroyd and Eddie Murphy wanted to trade those futures, in the 1890s, some innovative folks in Chicago said we had to clean up the back office, and they created clearinghouses for futures. And basically, a clearinghouse stands between buyers and sellers of a product and says if one of them fails, the clearinghouse will complete the trade. And the reason that's important in these derivative contracts is they go on for years. It's not like buying something in a store and walking out with a new sweater. You're entering into a contract that lasts for years. These clearinghouses did not necessarily exist or be required in this vast $400 trillion market. So an innovation of the 1890s had not been brought to this marketplace 120 years later. And the global leader said, we better do this. We better do this because it will lower risk to the system. In AIG, of the money that went into AIG, and every one of you put $600 into AIG, by the way. That it was $600 because that's what $180 billion is. And for your $600, you didn't get that much. You really didn't. You hopefully saved the economy, but you didn't get much. To avoid that, because 2/3 of the money that went into AIG immediately went through AIG to other banks to support the derivative transactions with other banks, the president, leaders around the globe said, let's use that 1890s innovation, clearinghouses. So where are we this month? Mandatory clearing is a reality for the interest rate market. Of that total market, as of October 25th, it was $340 trillion in size. These are big numbers, but that's, 85% of the total swaps market is interest rates. And of that market, 57% is now cleared. And just the last week of data that I was able to get for this speech, 80% of what happened in the last week in October was cleared. That is remarkable because in 2008, only 21% was cleared. So we've taken clearing up fourfold, and it lowers the risk of the banking system. And Bob will understand it. If I also say we made sure that as of October 9th, we covered all the offshore affiliates of U.S. banks as well. The third part of reform that we did was, well, what about these dealers? What about these big banks and financial institutions like AIG? Should they also get some oversight? We've had functional regulation in our country for over 100 years. Functional regulation means an insurance company is regulated for insurance, a bank is regulated as a bank, et cetera, et cetera. But one of the reforms that President Obama laid out, and Secretary Geithner and others, was that we needed activity regulation as well. We needed that if you were going to deal in these products called swaps, that you had to meet some minimum business conduct standards and capital and other standards. We're the only country that actually put that in place, and it's led to some interesting debates and challenges around the globe, but Congress put that in place. And where are we now? The reforms are in place. We have 88 registered dealers. All 88 of them are not unique, because sometimes some of the banks register multiple times. But we have all the big 16. It's called a G16, the group of 16, the biggest banks around the globe. And they're regulated for their activity as AIG was not. That means they have to have certain standards of business conduct and risk protections. Now, since 2009, in that meeting that President Obama had in Pittsburgh, there's also been a lot of international coordination. And the CFTC has consistently worked with our colleagues in Europe, in Canada, Australia, Japan, other Asian nations. And we've been on a journey together, and fortunately, in the European Union and Japan and the US, we've actually passed reasonably strong laws and similar laws. But we're not always exactly the same because we're different political systems, we're different cultures, and we had different crises. They did not have $600 of each of their citizens' money in AIG, as we did. But we also felt very strongly that we couldn't forget the lessons of finance. And AIG nearly brought down our economy, but they were operating their swaps business not in New York or Chicago or Connecticut. It was largely operated out of London. AIG Financial Products was registered as a French bank with a branch in London, with a guarantee from its mothership back here, the bank. 15 years ago, I was sent by Secretary Bob Rubin up to Connecticut to investigate what was happening at a hedge fund called Long-Term Capital Management. Some of you may have heard of it. And it was run by some brilliant people that were, I think there was a Nobel laureate involved and so forth. But it was failing. And I remember the call I made to the secretary that Sunday evening in September of 1998. And I said, Bob, it's going to go down by Wednesday. I said, Gary, what does that mean? I said, I'm not quite sure. It's got a $1.2 trillion derivatives book. It's got a lot of exposure. But Bob, there's something else. It's traded out of Connecticut, but it's registered in the Cayman Islands. I had no answer for the Secretary of Treasury, and I know Bob knows. If you made that call to Nick Brady, there'd be a little pause on the end of the Treasury Secretary would not be happy. Bob stayed calm. Long-term capital management lesson, though, could not be forgotten when we went through this crisis. Bear Stearns started the crisis. Their affiliates were in the Cayman Islands. Citicorp, their affiliates were in the Cayman Islands. Over and over and over again. Lehman Brothers, when they failed with 3,300 legal entities in their corporate family. And all of the major banks in the U.S., the big six, or the big five, if you wish, have thousands of legal entities, sometimes hundreds of legal entities in the Cayman Islands. Doug Shulman can give you a lecture why. He was the head of the IRS. But I couldn't. I can just tell you it's a reality. So reality of modern finance is, though, if any one piece of this multiple thousands of legal entities comes down, it will bring down the entire place. So U.S. Congress knew this. Barney Frank really had the leadership on this, and he included a provision that we could cover the far-flung operations of U.S. financial institutions, and that's exactly what we've done. It was not without a lot of debate. It had a lot of debate. It was probably of the 60-plus rules and guidance as we finished the stormiest, the most interesting time, but we got it done. And as of October 9th, it largely went effective. And it means we do cover, through our reforms, the offshore branches and guaranteed affiliates of the U.S. financial system. And yes, we do cover those hedge funds operated in Connecticut with wonderful jurisdictional places and vacation spots like the Cayman Islands. I personally have visited the Cayman Islands, and it's really a wonderful place, and it's wonderful to swim with the stingrays, but you don't really want to rely on their oversight of our financial institutions, with all respect to the Caymans. Look, today I want to mention one other thing. Today, the CFTC announced its fifth settlement with a bank for pervasively rigging interest rates. I don't know that any of you would have maybe read it this morning, but we did. These interest rates, called the London Interbank Offer Rate, LIBOR, or Euribor, are critical reference rates for the U.S. economy. Student loans are sometimes tied to them. Mortgages are tied to them. Small business loans. And yes, 70% of the international derivatives market, our futures market, our swaps market, are tied to LIBOR and Euribor and so forth. Unfortunately, we once again see how the public trust can be violated through bad actors readily manipulating benchmark interest rates. Through hundreds of manipulative acts over 6 years in 6 offices with dozens of employees, including a senior manager. Today, we announced a settlement with Robobank out of Europe. It's our 5th settlement. I wish I could say that this won't happen again, but I can't. And the reason I can't is because these interest rate benchmarks are not sufficiently anchored in real transactions, observable transactions. Thus, basically, they're more akin to fiction than fact. It would be a little bit like a journalist writing stories and not having real sources. And yet, these banks are continually putting in rates, but the interbank market, the market of lending between banks, is quite a bit different in the last 10 or 20 years. So that's why I'm glad that the international community is actually working to find alternatives and to find ways to transition to these alternatives. But these current rates are not sustainable. So those are some of the things that we're doing on reform. Before I close, I will say that to actually have markets be well-functioning, you need well-resourced agencies overseeing them. That's not what the CFTC is right now. We're 675 people right now, which is about the size we were 20 years ago. In 1993, as Bob was leaving the U.S. Treasury, we were 635 people 20 years ago. And yet, we now oversee this $400 trillion market, which is 10 times the size of the futures marketplace that we used to oversee. Now, you might not have liked the umpire's call in the Red Sox game the other night, but they're looking better now, so we can all be rooting for them tomorrow night. But you might not have liked the umpire's call, but can you imagine if Major League Baseball expanded tenfold and you didn't expand the number of umpires? If you just still had the same number of officials and they had to spread out over 10 times more games, it wouldn't work too well. The fans, after a while, would lose confidence in the game. And I think that's really what's going to happen here. We have had the resources to write rules, but it's completely different than overseeing a marketplace. We have a 5-person commission. We have excellent attorneys who can help write a rule, but we actually need people to examine for compliance, to answer questions, and yes, occasionally, to root out the bad actors and bring lawsuits. Worse yet, as a result of this funding challenges in Washington, what's called sequestration and so forth, we've actually already shrunk 5%. It's 35 people, but it's 5%. In addition, I did something no chairman of an agency likes to do earlier last week, and I had to send out a notice to employees that they're going to be put on administrative furlough for up to 14 days this year. Now, we're not the only agency that's done it. Last year, the IRS did it, the Office of Management and Budget, the Defense Department. But that is what we are facing with right now. Our agency, that's already shrunk 5% in the last year, is now through administrative furloughs, in essence, instituting a pay cut. That's the only way you can say it. It's 14 unpaid days in a year. And I think that that's the greatest challenge that we have as an agency, is not writing rules. It's now somehow convincing Congress that we're a good investment for the American public. So with that, questions?
Listen, I'm going to open the floor in just a minute, but I want to preempt and take the opportunity just to ask Gary a couple of questions. You talked about the tremendous accomplishments that the CFTC has.
Well, you gave me a chance to brag about this agency.
Well,
so.
And you did, and did rightfully so, for what you've done since the financial crisis and the DoddFrank Act. What are the major things that have been left undone in the trading and clearance of derivatives, and what do you think are the major roadblocks to getting them done?
I would probably name, I mentioned them, but I think the two biggest things, we're an under-resourced agency. The president thinks we should be about 1,000 people and has asked Congress for that, and we're only 675. And I think these benchmarks these interest rate benchmarks that have been so readily and pervasively rigged. 5 institutions, each one of them are a little different fact pattern, but it's over 4 years, 6 years, sometimes dozens of employees. All 5 institutions, or the 4 banks, all involve senior management in some regard. That's an undone challenge, and it's a very real challenge. I think we have the ingenuity to do it, but the Canadian dollar interest rate benchmark called Canadian dollar LIBOR, that's been disbanded. Australian dollar LIBOR disbanded, et cetera. We haven't yet done that to the US dollar LIBOR because it's in the plumbing everywhere. But it's like there's a toxin in the water. This thing is not in the right place. But we've said to the American public, though in Canada we replaced the bad water, and we replaced the bad water in Australia, there's just too many Americans using the water. We're going to keep using this thing called LIBOR. And that is undone. And thank God, Mark Carney, who runs the Financial Stability Board, he's the central bank governor of England, has taken it on. There is an international community of interest, Jeremy Stein at the Federal Reserve and Martin Wheatley. And so we'll see how that goes, but it's not an easy challenge, but it's undone. So.
Okay, good. Thanks, Gary. With that, let me open the floor. Most of you know the ground rules. Please identify yourself, and please ask a question, okay, rather than anything other. Please.
Hello. I'm Zoe. I'm a sophomore at the college, and I'm asking this question on behalf of the JFK Junior Forum Committee. How did the recent government shutdown affect your work, and how are you now working to overcome it?
The shutdown was surreal. There was, as it turned out, I think 31 of us who kept coming in, and 650 didn't. And so every day we had a 4 o'clock meeting with all 31 of us, the entire CFTC, and I went around the room. Has anybody heard whether the clearinghouses are still functioning? I mean, we were not overseeing the markets. There's no way to suggest that we were. I learned a lot about the water chiller and how, I mean, literally, these are things I had to figure out. Long term, I'd say what it does is it really is another body blow to the morale of the staff. A staff that knows we're underfunded, feels proud of what they've done, but keeps hearing back from Congress, no, not only shouldn't you be funded more, but the House of Representatives has cut our budget consistently, and then the Senate has to come back, and so. But I'm still encouraged. I believe in our democracy. We're going to keep, making the case to the Congress. The president's been terrific making the case, and I think that at some point in time we'll get more funding. We are in a circumstance, though, we're not examining or overseeing the markets even now the way we should, and occasionally we even shelve enforcement actions. Our enforcement staff is 10% smaller than it was a year and a half ago.
Yes, sir.
Hi, my name's Christian Pico. I'm a Stanford grad. I work at a startup right now.
I'm sorry, you're a Stanford grad?
Yeah.
There you go. Wow. Open forum.
I'm curious about what the effect of, say, a 1% Wall Street sales tax would be, like the Tobin tax, like on that mass of hundreds of trillions of dollars of derivatives. Both, like, what could likely be extracted from that, what effect that would have on the pace of these derivatives transactions, and then what obstacles are there to implementing such a tax, how difficult it would be to regulate, or then from a kind of more political standpoint, who are the actors that are against that, and whether it might help extract Americans out of the crisis in a faster way?
Well, I presume you don't really mean a 1% tax, because 1% of 400 trillion is 4 trillion, and that would be sort of an interesting dynamic. I'm guessing, but maybe you were.
1% on the turnover.
Yeah. What's that? All right, well, I'll stay out of the intramurals. I went to Wharton, so, but look, I would say this. If you're asking a question about a transaction tax, we currently in this country have transaction tax in the securities field. It is set each year to anticipate what the cost of our securities regulations are for the next year. And that's been true for a couple of decades. Well, it changed a little bit after I left the Clinton administration. But so we have, it's a very modest transaction tax, but it pays for the approximately $1.2, $1.3 billion budget of the Securities and Exchange Commission. That type of transaction tax to pay for the market functioning better and promoting the markets, I've said to Congress all along in my 5 years in the job, I'm completely open, and the President has recommended to Congress that we have something to help pay for our, we're a more modest agency at $195 million. The President thinks we should be at $300 million. I agree with the President. That type of movement would, I think, would help fund us. And to answer your question about how do we get there to get in essence, some transaction fee to cover a $300 million budget, it then gets caught up in all the usual dynamics of is it called a tax or not? How does it fund an agency? Does the swaps market pay it? Does the futures market pay it? And then all of a sudden you get all the reasons why often in our civil society that the status quo wins out and you don't have something to help fund us. But you might have been talking about something a little broader, a 1% tax, which I think my own view is then you wouldn't get the same economic vitality. I think these contracts, these hedging contracts, not the way Eddie Murphy was using them maybe, but these hedging contracts are vital to our economic success. And I think you want to foster that activity.
Yes, sir.
Hi, my name is Jacob Morello, and I'm a junior at the college studying economics. So my question is, after DoddFrank was passed, what was the feeling like inside of the CFTC? It's this huge regulatory task that lies ahead. And what's the sentiment for the average worker in the agency? Excitement or just feeling overwhelmed?
It's a great question. The day before the President signed the bill, I pulled together about 50 or 60, so about 10% of the staff in a room, and they were going to be the key leaders writing these various rules. We assigned team leads, and there was a fair bit of excitement, but we were an agency that done maybe 3 to 5 rules a year, and we were being asked to do 60, and Congress gave us 1 year. So we looked, I was in the business world, we looked at every gating factor we could find, anything we could do inside our agency to go from 3 to 5 rules a year to 60. Basically moving a lot of regulatory inventory. There was pride in the agency. There were many people that felt for a couple decades that we should have overseen a marketplace, but it was a daunting task. And 3 years on, we've largely completed the task. I think there's still enormous pride in the agency, but a respect for it was a really big challenge. So, and they would like to have more people, to help share the responsibility.
Yes, sir.
Hi, my name is Leo Markel. I'm a first-year HBS student.
I see the T-shirt.
Oh yeah, I was Wharton undergrad.
Oh, all right.
So my question is regarding clearinghouses. It sounds like counterparty risk shifted from individual institutions to the clearinghouses. Could you please speak to the challenges and the abilities to manage that risk for the clearinghouses?
So these contracts can stay outstanding 30 plus years, about, remembering the figures, I think over 2/3 are 5 years or less, but they stay out for a long time. And the central innovation of clearinghouses in the 1890s and it really is that innovation, is that on every single day that a transaction is still outstanding, it's valued. So fundamental to clearinghouses is you do not want to have a contract in a clearinghouse that is not readily valued on a daily basis. And two, the innovation was that when it's valued, the loser on the transaction has to put more money in, which is called variation margin. That's, fast forward to now, that's what we're doing. That's not what AIG was doing at all. There are now pretty robust international standards around clearinghouses. Paul Tucker, who I think is going to be a senior fellow here in a few months, or if not, he's already here. All right, so Paul will be here in a few days. Paul, who's from the Bank of England, who's deputy governor, really stood at the center of coming up with these international standards. I think clearinghouses are not without risk. Nobody should assume risk ever goes away. There's not without risk. But I think they're a far better model than leaving the risk in the banks. Number one, they have to value the transactions every day. Two, they have to collect variation margin every day. And three, believe it or not, they're not in any other line of business. They're not in the lending business. They're not in other businesses. And I think this is actually, it's sort of a wrong feeling sometimes. The diversification is usually studied at Harvard and Wharton and, yes, even Stanford, that diversification is a good thing and all of that, the capital asset pricing model and all those things. But I kind of think that it's not in this one situation. I think when you put all these contracts and you let banks also be effectively clearinghouses, as AIG and others were, they're using their balance sheet, but then when crisis comes, it can bring down so many others. But there's still significant challenges in clearinghouses, particularly as they compete with each other on risk. And I think that's the challenge going forward, to ensure that the clearinghouses always have robust risk management.
Good evening. Thank you for coming. My name is Carwin. I'm a junior here at the college, and I have one question that might be a bit more sensationalist in nature.
Great. I'm looking forward to it. More than taking $4 trillion out of the swaps market and as a tax?
I'm hoping so.
Okay.
So when you look at the recent financial crisis and when you look at the recent London whale incident, where you see individuals taking on arguably reckless amounts of risk, when you see them hiding losses in off-balance sheets, there seems to be a tendency for regulatory agencies to punish these individuals within these organizations and these organizations in general by giving them a fine, which in some cases, JP Morgan, for example, fines amounted to about $1 billion, which for them seems like pocket change, especially considering the fact that they recently made $23 billion in profit in 2012. Is there anything that regulatory agencies are doing to make the punishment a little bit more stiffer, to possibly incentivize them to stop doing things that might be too risky for an economy?
Well, you raise an excellent question about the use of enforcement tools. We are a civil law enforcement agency, as other than the Justice Department. That's how our society is organized. And we've brought these 5 big actions on London interest rate market. We did bring one of the actions against JP Morgan Chase and settled, gosh, it was last week. It's been a busy couple weeks, or 2 weeks ago. And it was for reckless misconduct in that circumstance. In terms of the size of the fines and the penalties, which I generally take the recommendation of our wonderful head of enforcement, David Meister, you raise a question. We are always trying to get to the right conclusion, often telling a bank that we're ready to file, and we were in that circumstance ready to file in a court. And in these London interest rate markets, certainly a couple of them, we had to go all the way up to that line to file in a court and go in front of a judge and a finder of facts and law. But I don't think of fines. I don't think of fines as maybe the way that you do, if you're saying in light of their earnings. we generally think of fines in light of our law. I mean, we actually, as an agency, have a law that has a maximum fine per incident. So we sometimes have to multiply hundreds of incidents times a number in our statute, 140,000, and kind of work up what a fine will be. So we're doing it within our law.
Then one more question. If the purpose in fining them is to ensure that they're conforming with the law of the land, and if that law and that enforcement doesn't get them to conform with the law of the land, is there any other tool of enforcement that you can use to get them to do what they're supposed to be doing?
Well, our enforcement actions also help change behavior throughout the marketplace. I mean, I would sure hope after doing 5 of these on the LIBOR market that we somehow would do that. But yes, we also enter into what's called legally binding undertakings. That it's not just a dollar amount, but there's also specific undertakings. And there's also some, and when I say undertakings, then if they trip that, we had one, I know it wasn't particularly popular, but InTrade. InTrade was a platform being run, believe it or not, for gold and silver and other commodities, as well as betting on elections. But we brought an action, I think it was 6 or 7 years ago, and there were various undertakings, which then 5 years later they weren't following, and well, you might know the history now that we had to bring another action. So the undertakings themselves are often quite important. And lastly, sometimes we are in the position of talking to somebody about pulling their registration or their licensing. I mean, just like you have a driver's license, I assume, from somewhere. I mean, there is a registration regime, but that's a pretty big thing when you're talking about a multi-trillion-dollar bank.
Let me ask you 2 other dimensions of the enforcement actions that come up a lot now. Enforcement's against people rather than institutions. And the other issue of requiring, particularly the institutions, to admit to something as part of the settlement process.
I think it is important that and again, we're civil law enforcement, but important that it can be institutions and people. Sometimes there are decisions based on the limited resources. Even in this J.P. Morgan situation, there was a number of traders that the SEC and the Justice Department and some others were bringing actions against. So we have resource issues, and we might say, another agency is doing that. So there's some of that. But I think it's very important. And in really a number of our largest cases, and certainly this J.P. Morgan Chase case, they admitted to recklessly entering the market on Leap Day last year. It happened to be February 29th, but on Leap Day last year. But often, as we're making those decisions about the use of limited resources and going into court or not going into court, if we can get a settlement that basically has a clear recitation of the facts and everybody's agreeing to the facts, that's a strong piece of it. So.
Up here, hi. My name is Josh. I'm a master's student here at the Kennedy School. I worked for 7 years on Wall Street, and then next year when I graduate, I want to go work in D.C. for the government. And so I wanted to ask you, and I think many people here might be interested in, what advice would you have? What do you think contributed to your success across so many agencies as you move from the private sector to the public sector? Or if you could go back to 1979, what advice would you give yourself as a graduate? Whatever you prefer to answer.
Gosh, thank you for the compliment. Mentors, make sure that you really take advice and reach out. One of my mentors along the way was Bob Rubin. I met him in my first month or 2 at Goldman Sachs. But I've had professors at Wharton that were mentors. Jamshed Gandhi was one of them. I mean, they're just mentors, I would say. Evolve and adapt. Let yourself evolve and adapt. Be persistent. I mean, if you have a passion to serve in government, then go pursue it. You got to knock on a lot of doors. There's hundreds of thousands of resumes that come into any presidential transition. And even late in an administration, there's still tens of thousands of resumes coming in. And so you have to really be persistent. And so those would be, keep lists. I'm a big list guy. Keep lists. I once got to know Neil Armstrong, who flew to the moon. He was on the board of directors at Taft Broadcasting, and when I was at Goldman Sachs, I advised that board. And he was the ultimate list man. I asked him, what did he do when he was flying to the moon? Did you peak some views? And in 1969, there weren't the computers we have now. He says, Gary, I was always dealing with my list of the next 10 things I need to do. Keep lists, and hold yourself and others accountable to those lists. So there's some quick advice.
Thank you.
Good advice. Yes, sir.
My name's Will Diamond. I'm a PhD student in economics. And my question is, sort of in academia, we feel like we know a lot of engineering solutions for particular policy problems, but we know basically nothing about what is and isn't politically feasible. So can you sort of summarize what is the balance of powers you have to deal with? Are there donations to congressmen based on them being against your agency? Do people who work at your agency have expectations of better job offers if they lightly regulate? Which of these possible corruptions are something you have to fight against?
I think you can really get a lot done in Washington. I absolutely think in our democracy, it might be noisy and messy, but let's not forget that Aaron Burr did take out Alexander Hamilton on the cliffs of Weehawken a couple hundred years ago. I mean, it's been messy for a long time. But I would say, I'd share some advice I got from a wonderful friend and mentor, Ed Knight, actually. He was the general counsel of the Treasury Department in the 90s. And Ed said, you're never going to get to policy outcomes in Washington unless you get the politics right, and you're never going to get the politics right unless you get your messaging right. You've got to have your elevator pitch. You've got to be willing to go into the public square and advocate for what you believe in. And that's what we did at the CFTC. We have constantly been in the public square advocating and trying to find allies. You have to build coalitions. Without a coalition, you can't get something done, because in a democracy you need the permission of the governed. The sovereignty rests in the people. And so that's a good thing about democracy. So policy doesn't mean anything unless you can really convince the public and the press and their representatives, so to speak, of where you're going. So messaging, politics, and then you can get to some good policy. I'm not too worried about the other things you raised, by the way. I think democracy is noisy and messy, but it does work. And I say that even after a government shutdown.
Hi, my name is Divya. I'm also a graduate student in the economics department here. So I'm working on this, but I have a view. But what do you think the fundamental purpose is, the economic purpose that reference rates are serving? Why do they exist?
Wait, economic purpose of what?
Reference rates. Why do they exist? Things like LIBOR.
I think that we have vast markets, and I would say even a desire and a need to be able to reference for a central price of just about any commodity. In the 19th century, the reason that our markets were invented in the 1860s was in part because farmers wanted to lock in their price at harvest time. But they also wanted to have something more than their local grain elevator operators' pricing. They wanted that reference that was more than local, it was at least regional, which became Chicago because of the Great Lakes. And I think similarly, the London Interbank rate started in the early 70s. I've met some of the people that worked on the transactions, actually, that some companies wanted to borrow based on a reference rate, a wholesale rate, something that was hopefully not manipulated, but was a reference rate. and they wanted to lock in that price. And they were willing to say, all right, I'll pay a certain spread to that wholesale price. I'll pay so many basis points over, which is retail. So I think there's a tremendous public good, but it's been trampled upon in LIBOR. And so students taking out a student loan have some confidence, maybe, that they're paying just a spread over some insider's, price, as long as that's not manipulated. So that's a good question. I've never been asked it, but I think that's the central, there is an economic good, I guess, because what is it called? Externalities and things like that. If I have to remember those words, did I?
Very important word around here, externalities.
Something like that.
Well done. Is it?
Hi, I'm Jacob.
Here, and then, of course, to the Red Sox. Got to do that.
My name is Jacob. I'm from a graduate student at MIT, actually, and I
Okay.
have a very boring question for you.
All right,
Which
we'll
is,
try.
what exactly is the organizational structure of the CFTC? Like, how does your legal branch interact with maybe your research branch, or is it more like fluid or
No,
hierarchical?
like any organization, we have boxes. And if you went to business school, you somehow have to align these. We have three, what I'll call frontline program divisions, each between 60 and 100 people, overseeing markets. Those are the trading platforms, overseeing, secondly, the clearing houses, and thirdly, overseeing the intermediaries. So we have and we reorganized in the last 5 years, but the market platforms, the clearing houses, the intermediaries. We have a small chief economist's office of about 15 people. That's shrunk, 12 now. And then we have a general counsel's office with about 50 people. And that general counsel's office and the chief economist's office serve the other divisions, but we also have, this was true at Goldman Sachs too. It's almost in every organization you can have. We have distributed lawyers in each of the divisions. We have distributed economists in each of the divisions, so that central pool of economists and that central pool of lawyers is not all the lawyers. Probably only 50 of the lawyers out of, we might have 30% of our staff as lawyers, somewhere around 180, but only 50 are centralized. And then we got a lot of distributed lawyers. And we have a lot of distributed economists too. So does that help? And then, of course, we have the political side. We have a very small 2-person legislative affairs office. Maybe if we had more, we could get more funding from Congress, but so. Red Sox.
Yeah. My name is Mario Jaimes. I'm an MPA student at the HKS. And considering the trends that we have lived in the last 20 years about the concentration of the players, more sophisticated operations and stronger interrelationships across international markets, what are the main macroprudential regulation problems that we face in these years?
The main macro potential?
Yeah.
Well, I think that we have great challenges in the U.S. budget. I think, till we get that quite right, we as a nation will be challenged. I think we have risks still out of the European debt and European banking, or the Eurozone itself, and how sustainable that is. And either our debt issues or the Eurozone issues could spill out in ways that are certainly hard to predict. Hopefully won't. They might be what's called small probability tail risk, but they certainly are very real. And then I think the banks themselves, the greatest challenge is that though I think we did great reforms out of DoddFrank, there still is in the marketplace some perception that large banks, the 15 or 20 largest around the globe, have the support and the backing of their respective sovereigns or taxpayers. And I think that we've probably done more in the U.S. to address that than elsewhere, but you still see that in the credit markets, that there's still some perceived benefit that governments will back their, and I think that distorts markets and ultimately Look, my dad never went to college. It wasn't about Harvard. He didn't even go to University of Baltimore. And he started a business with his mustering out pay in 1946. And if he didn't make payroll, he never had more than 30 employees. If he didn't make payroll, the city of Baltimore was not going to bail him out. There is a freedom to fail in our society that ought to be just as true for a $2 trillion bank as it is for my dad's business. And I think that crosses the political spectrum. I just think that's, and we woke up in September of 2008 and saw our government, on our behalf, saving the economy, so to speak, but messing with that core belief that there's a freedom to fail. That's the last issue, I would say.
Listen, I'm the timekeeper for this, so let me take one last question.
Hi, my name is Sonia Barnes. I'm a joint degree candidate here at the Kennedy School and at the law school.
Great.
So you spoke a lot about how after DoddFrank was passed, there was a dramatic increase in the CFTC's regulatory responsibility without a corresponding increase in federal appropriations. So I'm wondering if you can speak a bit about how the agency prioritizes its activities and decides where to focus the limited resources that it has.
So it's a great question. In our overall strategic view was to get the rules in place. We did recognize that one of the challenges of limited funding is if we didn't even get the reforms in place, the black letter that was signed into law by the President of the United States might not actually really ever be the law of the land. Because in 60 places, Congress asked us, not only asked, directed us to write a rule. So that was a big priority. Now, it doesn't take the whole agency, but 100 to 150 people at one point in time, maybe upwards to 200 people, were the economists and the lawyers and the analysts and the commissioners working on that mini legislative function. In terms of enforcement, in terms of registration, it was to get these new entities registered. But frankly, because of limited resources, we've done a very cursory review giving people licenses. It's like saying, you can drive on the road, don't worry, here's your license, we'll check you out later. And we've done a lot of that, but we've felt that we've got to get these trading platforms licenses called registration, or these dealers licenses called registration. So a big task in front of us is now going back and seeing whether they're actually complying with the rules in place. And I think it's a worthwhile place to close. That's our big challenge going forward as an agency, beyond LIBOR and all these other things, is now we're moving into the role, just as we did on J.P. Morgan's London Whale circumstance. We had a law that Maria Cantwell championed on manipulation. We had a rule that we had finalized in the summer of 2011, and then we had a set of facts, and how we married those facts and whether we were able to marshal individual lawyers to look at those facts in a 17-month investigation and bring a case. And that's what will be happening for the next, I'm sure, years, because this is a new law and a new set of rules, but without resources, we'll constantly be, in essence, doing triage.
Thank you very much.
Yeah. Is that what you want me to